So where we left off in the last video is we were basically saying that money is a commodity. And it is bought and sold. And as with any commodity that is being bought and sold, the objective is always to buy cheap and sell high. Buy low, sell high. If you learn nothing in economics, the one thing that you should always remember is that you should always try and buy low and sell high. Sometimes buyers buy in one market and sell in another, where the prices are slightly higher. That would be like if you have two different auction barns, relatively close to one another, and one is selling cattle for 5 cents cheaper per pound. You go and you buy the cattle from the auction barn that's selling them at 5 cents cheaper, turn around, you go to the second auction barn that's selling them at 5 cents higher, and you sell them there. So you're buying low and selling high. Well, this can be done with cash or with money. So the buyer may repackage the commodity and sell it at a higher price. The generic term for all firms engaged in financial markets is financial intermediaries. Financial intermediaries include insurance companies, pension funds, credit unions, loan agencies, savings banks, commercial banks, and merchant banks. All financial intermediaries that are buying and selling money. So how do you really buy and sell money? If you have ever put if you have ever put cash or dollars or money inside of a savings account, you've actually sold money. So, banks and other financial intermediaries borrow money from depositors. So, they're buying money from depositors at one price, and they lend it to borrowers at another price, at a higher price. So what happens in the banking industry is whenever you put money in a savings account, you receive interest on it. So what you find out is that the longer you leave your cash inside of this savings account, you actually receive payment for that. Your actual cash starts increasing in this savings account the longer you leave this amount of money in savings. What is happening? The bank is paying you. They're buying this money from you. They're paying you to borrow your money. Then what do they do with that borrowed money? They take it and they lend it out. They package it as a loan, maybe a mortgage loan, maybe a loan on a vehicle, but they lend you money. And what do? They lend it to you at a higher price. So if you look at your savings account, if you have a savings account, look at it the next one of these days and find out what the interest that you're receiving on this savings account is. So if you put $1,000 in a savings account at, say, less than 2% interest, or say right at maybe 0.02% interest, what's happening? These banks are taking that money that you lent to them, are turning around and they're selling it as a loan to somebody else, and they're charging a higher interest. So they take that $1,000 that you set in the bank and they sell it at an interest of, say, 8% or 7% or 5% or something higher than what they're actually paying you in interest. So that's one way that money is often bought and sold. So the difference between the interest paid to the depositors and that charged to the borrowers should cover all costs of the bank. And of course, they're going to provide a reasonable profit. That's why a bank pays you interest on a savings account or a certificate of deposit, because you're guaranteeing that you're leaving a set amount of money in this bank. The bank is going to pay you for it, and then they're going to take that same amount of money and sell it to somebody else at a higher interest rate. And that's how the banks are making their money. And that's how they're able to cover the cost of the bank And of course, they're going to try and provide a reasonable profit for the bank. So, in commercial banking, there's a regulation for all banks. And that is they require that they loan only a fraction of each dollar deposited, such that the bank has some reserves for which withdrawals can be made, and this is known as the required reserves. So the required reserves is the amount of money that the bank must keep either on hand or in the Federal Reserve or in deposits, and be able to access this amount of money in case somebody comes into the bank and makes a withdrawal. So, if we go back to this example of you taking $1,000, you're putting it into a savings account, and you're getting paid, say, 1% interest on it. They turn around and take every last cent of that $1,000 and they sell it in a loan for 5% interest. They're making 4% on it. Everybody's happy. But you decide that you want to utilize some of that money that you put in a savings account. So you go in there, you go into the bank, and you say, I want to withdraw $500. Well, they've already sold that $500 to somebody else. They no longer have it in their possession. They're making a profit off it, but they don't have it in their possession. Well, to keep this from happening, there's a certain amount of required reserves that each bank must maintain. And they must maintain a fraction of each dollar deposited. So say that you went in there and deposited $1,000. They must keep, let's say hypothetically, 20% for easy figuring. So the bank keeps $200 readily available at all times. Well, if they get more depositors, each depositing $1,000, they have to keep 20% of it, and this continues on. Now they have, say, $5,000 in savings, and they've had to keep $1,000 on hand. And then you, as a depositor, would like to withdraw all $1,000 of that cash. You can walk into this bank, withdraw this $1,000, and the bank still has enough money. And on top of that, they were able to loan out the difference between these two of $4,000. So the required reserve is a set amount that the federal government is requiring that the banks keep on hand in case somebody would like to withdraw something from their account. So, the remaining portion of deposits, which are not required reserves, are known as the Loanable Fund, since these are funds that the bank can lend out. So if we go back to our example, if they have $5,000 in the bank, they are required to keep 20% of that. They have $1,000 on hand at all times. They have to have at least $1,000 on hand at all times. They now have $4,000 that they can lend out. This is their loanable fund. And it's basically the amount of deposits minus the required reserves will give you the loanable fund. So, reserves banks are required to hold, take in two forms. The first is cash in the vault. So a bank on these required reserves, they can either keep these reserves in one of two ways. The first one is they can keep cash in the vault, that which you expect the bank to have whenever you show up requesting it. They can either have cash in the vault, or they can turn around or they can make deposits with the Federal Reserve. That is the two ways that they can keep required reserves.